Okay guys, welcome to this very short video. So this short video is basically about baiting the market. So it's almost like you're going fishing within the Forex market, if that makes sense. So this video is kind of for people who are maybe a little bit more aggressive with trading and maybe tend to try and find those kind of reversals, or maybe don't look for as many confidences within their trading. Now obviously, understandably, this is a psychology course. I don't want to go too in depth about my actual strategy in depth, because obviously that's part of the BS FX course. And those of you who have purchased the BS FX course will understand this video a little bit more in depth. But this is just a breakdown here of euro to the pound. So this was some trades that I was giving out last week, and I think sort of the week before. So yeah, so this is kind of recent price action. Now within this video, obviously I'm going to show you just some examples. Now you might not understand it, but the actual technical analysis behind it. But what's most important to understand the actual concept of what I'm trying to teach. So the concept itself is baiting the market, fishing the market. So what it's really about is when you're trying to pick reversals, it's about going in at half risk initially until you can bank profit on that initial half risk to then allow you to compound and add additional positions on scalings. Okay, so what I mean by that is if we're looking at euro to the pound right now, okay, euro to the pound hit a major resistance level between sort of 0.9300 and 0.9320. Okay, so this point here. Now, we formed this huge 4-hour bearish engulfing candlestick. Okay, now when we formed this bearish engulfing candlestick, initially, before seeing any of this price action, we could have assumed that that was just maybe some strong pullback to push higher. Now, what happened at that point? Price came up and it was basically stalling and failing to create a new higher high. So price was basically failing to push up to the upside. Now this can happen many a times, because obviously when we're looking at this on the higher time frames, we are bullish. Okay, we're bullish because we've not broken the most recent swing point, which you can learn more about in some of my other videos about picking tops and bottoms and things like that. So this is bullish. So all of these trends initially are counter trend trades on the higher time frame. Now what you can do here is, as you can see here, this sort of formation that you can see here actually hit the 61.8% fib. Now obviously initially you wouldn't have had this descending trend line on this, because you wouldn't have had these points to actually allow you to draw this descending trend line. But what's important to remember is at the moment you're trying to pick the top of this particular currency pair. That's all you need to remember right now. You're just trying to pick the top. Okay, so when you're trying to pick the top of the market, obviously we've got two confidences here. We've hit the 0.9300 kind of resistance level, which is a major resistance level. If we look left, we could have seen that. I'm not going to show you that right now, but just try and bear in mind the fact that 0.9300 is a major resistance pair for this particular pair. And then obviously what's happened is because we've hit the resistance, we've then formed a 4-hour bullish engulfing, which is only two real confidences to take this short. Now I always teach all of my members to go for a minimum of 3 confidences before entering a trade, and obviously we didn't really have 3 confidences here. All right, so what I'm trying to say is that your initial position when you've not got many confidences should always be half of your risk. Okay, so if you genuinely sort of risk 2% of your account consistently every single trade, then obviously you would be entering in at 1% risk on this particular trade. And obviously if you were normally risk 1% of your account consistently every single trade, then obviously you'd be going in at 0.5%. Now the idea is like with fishing, is you put a bit of bait on the end of the fishing hook, you send it out, and obviously you're baiting out the pond, you're trying to grab that first initial fish. Okay, so this is what this is about. It's about locking in the first initial position. Once you get the first initial position, all right, and basically you're sitting in some form of profit at break even, so basically your position is protected, you can't now lose on that particular trade, and obviously you've banked some profit as well. That's when you can then look to scale in, which is a technique that I teach within the BS FX course. You can look to scale in and add then a normal position on your secondary position, but actually you can look to add the additional half a percent or 1% or whatever it may be. So what I'm trying to say is with this, okay, what we could have done with this to try and pick this top and pick this bottom is we would have been aware And obviously you do need a minimum of at least 2 conferences. So we've got that already. We've hit the 9-3 and we've formed this 4-hour bearish engulfing candlestick. So we've got 2 conferences. Now you can't just randomly jump into the market with 0.5% risk. You do have to have something. Now we did have something here. Now what happened was when it came up and then it came down like this, it rejected multiple times on the 4-hour time frame. 1, 2, 3, 4, 5, 6, 7. And it also hit the minus the 61.8% fib as well. Now what you could have done here is because of all these taps and these rejections, you could have assumed that it was actually failing to create a new higher height up here. So this would have been your first initial position where you were baiting the market with only 0.5% risk. Now I only risk 1% per trade, and then I look to scale in. This is how I can compound the account, because I initially bait the market and then I add additional entries. So what you would have done here is you would have entered in at, say for example, 0.5%. Okay, so let's just type that out. So this would have been your entry. So the black line is the entry point. Okay, 0.5% risk. That's what you would have put on this particular trade here. All right, and obviously your stop loss, right, would have been this dotted line. Now you wouldn't have entered in on this first candlestick here because that's only one rejection. But what you would have done is after a few taps and a few rejections of this particular level, that's when you would have entered in maybe here or here. And obviously if we scale down to the 1 hour, we could probably see this a bit clearer. So let's just scale down to the 1 hour. Okay, we can see multiple candles. Okay, multiple candles here. Right, so you could have entered in maybe here, or you could have entered on this bearish engulfing candlestick here, or this shooting star here, on any of these candles. All right, so you're going a half a risk, a 0.5% of risk, or half of whatever your normal risk is. All right, so that would have been your first initial position. Now, once you were in on that position, okay, you would have been sitting in around, sort of 40 pips before your next entry. Okay, so that's 40 pips worth of profit. All right, so that's some form of profit that you've now locked into the market. Now you can then move your stop loss to break even. Okay, or you could potentially lock some official profit in maybe at 20 pips. Okay, so you could have potentially locked in, say, 20 pips and moved your stop loss maybe to here. So you have now banked 100% 20 pips. So you've locked in some definite profit. So regardless of however way this goes, whether this turns around against you, you have locked in 20 pips. Now, if you've locked in 20 pips or say 30 pips, what you can now do is you can look for an additional entry. Now, when you take that additional entry on a scale-in, you can then add 1.5% risk. Okay, so what you can do is you can now add 1.5%. Okay? Because obviously you've got your 0.5% that you missed out on this, and now you can add it onto this because you've locked in your profit. Okay, you've locked in some profit. So that extra 0.5% risk that you wouldn't normally have done, you can now do because you've locked in some profits. And now you can scale in. Okay, so your next scale in would have been this here, right? So you've got another sort of fib here. You see this? A, B, C. All right, you've got another fib here. Okay, so you've obviously got this shooting star 1 hour candlestick, so you can enter straight off this rejection here. Okay, and obviously what you've got here is you've got some support here to the left. All right, you've got your 1 hour shooting candlestick, and obviously you've got your EMA level here as well, and you're starting to build this descending trend line. So you're starting to build up the confidences as you go down. Okay, it's starting to become more confirmed as you go down. So now you've got 2% risk. Okay, you've got 2% risk. Now this one's locked in. This one's not yet locked in. Your stop loss is above here. Now obviously if you get stopped out on this trade here, okay, if you get stopped out on this trade here, you lose your 1.5%. Okay, you lose your 1.5%. But obviously you've still locked in this, your 0.5%. So then technically on this overall position of picking this top, all right, you've then only lost really sort of 1%. All right, you've only lost really 1% because you've already locked in this sort of 0.5% that you've got here. Does that make sense? So as you're going down, you're scaling in and you're adding more positions. Okay, you're adding more and more positions because you're using the profits that you've locked in, okay, to basically allow you to add more risk. Because what you're doing is because of the profit you've got floating, it allows you to go in with a little bit more risk. All right, so then what happens is price begins to obviously move down. Now your next scale on this particular pair would be this big drop here. Now you had this big drop here. Now at that point you've now got sort of another 80 pips there, all right, on your secondary position, and on your first position you've got sort of 128. Okay, so you've got 128 on your first position, 80 on your next. That's 200 pips you've now locked in at 2% risk, which is running beautifully. Okay, and then what you would do then is then you'd look to get in again. All right, so now what we've got here is we've got a 38.2% fib retracement. All right, we're still below this 1 hour EMA, and obviously we're still below this trend line. But most importantly, what's happened here is we're beginning to actually break major structures. So we're starting to get more and more confidence as we go down. So now what we can do is we can enter here as well. Okay, we can enter off these multiple taps here of the 38.2% FIB with our stop losses above. Okay, so now what we can do with this is we can actually go in a little bit more risk. We can go in a little bit more risk because we've banked in all this profit. Right, so we can now move this. We can move this stop loss even further. We can lock in sort of 50 pips, and then on this one we can lock in. We could probably lock in at least 35 pips. So we've got sort of 85 pips locked in, guaranteed. We've moved our stop losses. So what we would do is we'd move this stop loss, okay, to here. We'd move this stop loss, yeah, also to here. So now what we've done is we've locked in this position. We've locked in this position. We've got floating profit. Okay, we've got floating profit that's guaranteed. So now because of that, what we can do now is we can actually go in on this with 2%. Okay, we can go in at 2% risk. Okay, 2% risk. There we go. So now we've got 2% risk on this particular position. All right. So then what we do is then we lock in. We start to sort of get into some profit here. We've got our we've got at least some percentage here of our account locked in. So if we get stopped out on this particular position, it doesn't matter. It doesn't matter because if we get stopped out and we lose this 2%, it's still not gonna take out this. I mean, we might lose maybe 0.5%, something like that, if we worked it out mathematically. But it's still worth the risk to reward. Does that make sense? It's still worth it. So then what we can do is we locked in 2%. Okay. And then we come up almost to the original position, and then we drop and we break this counter trend line here, right? So then we drop, and then we come back up. So let me show you this on the 4 hour. Our next position would be here. Okay, so let me just show you this quickly on the 4 hour. Our next position would be here. Okay, this see this spike here? Now the reason why is because this is the FIB from here to here. Okay, so it's a bigger FIB. Alright, and we're rejecting now the 38.2. Now, most importantly, we're not just rejecting the 38.2. We can actually see that we're in a head and shoulders formation here. So we've got the left shoulder, the right shoulder, okay, and then obviously we're also hitting the EMA. Alright, so we've got a nice duplication of the left shoulder to the right shoulder. We're hitting the EMA, and we've got this descending trend line. So we're starting to build up even more confidences as we go down. So we've got profit locked in here. We've got a few percent locked in here. We're starting to build our risk as we go down because we've got profit locked in to help cushion us with that extra risk. And as we're coming down, we're actually starting to build more confidences to actually take the trade. So it's becoming a little bit less riskier when we're entering into these trades. So let's just go back to the 1 hour. Okay, so this is our next entry here. This is our next entry. I know it's looking a bit confusing because there's so many labels and stuff like that, but this black line is our next entry. Okay, so then we can go in on this with 2.5% risk because we've locked in even more profit here. So we can go with 2.5% risk on this next entry here. Okay. So then price drops, comes back up, messes around, and then it drops. So now what we can do is we can move this stop loss for this entry down to here. And we can move this stop loss here of this entry down to here. We can move these two stop losses here for the original entries down to here. We can move this stop loss here from that entry down to here. And now we've got 4 positions locked in. 4 positions locked in, guaranteed profit. Okay, guaranteed. So off our first position up here, we've got 180 pips locked in, okay? And then our next position, we've got another 140 pips, right? So that's nearly 300 pips. And then on this position here, we've got another 80, so that's 380. And then on this position here, we've got another 60, okay? So that's 460 pips, guaranteed, locked in, and we're flowing at some amazing profits. Okay, amazing profits. So we can just start moving all these stop losses collectively into obviously one area now to lock in this profit. Now, obviously, what can happen with this his price could drop like this, and then it could come up. And you see this little spike here? This could have stopped you out. It depends where you want to put your break even. You might want to put your break even here. Okay, you might want to move your stop loss to here instead. It doesn't. It depends on you and your structure. I'm just doing this as an illustration to explain the concept. You could have put it here. You could put it here. Now, even if you did have all your stop losses here, okay, even if you did have all your stop losses here, and then something like this did happen, yeah, where it did come up and stop out all these positions that you take, does that matter? No, because you've banked like 380 pips at like what you've got 2.5 here for this bit, 2% here, 1%, 1.5% here, 0.5 there. So it doesn't really matter because look how much you've made off your account. You would have made serious amounts of money. Serious amounts of money. I mean, we can mathematically work this out together. So let's say, for example, you have a £10,000 account. Okay, £10,000 account. Now, so let's say 1%, okay, equals £100. Yeah, 1% equals £100, and 0.5% equals £50. Okay, and then we've got 2% equals £200, and then we've got 2.5% equals £250, like that. Okay, now that's what we're risking. Okay, so on this 0.5% risk, let's work that out together. So if our stop loss initially, okay, was 15 pips, okay, 15 pips, what we would do is we would divide this by 15 pips. Okay, so what we would get as a position size for that particular position that we took is we would do 50 divided by 15 equals 3.33. Okay, 3.33. All right, so that would basically work out at 0.33 position size. Yeah, because we're doing £3.30 per pip times up by 15. So that's our initial position size on that one. Now on the 1% trades, this 1% trade here that we sorry, we're doing a 1.5%. Let me just recalculate that. 1.5% would be 150. Now on this position here, our stop loss was just above here. So again, it's probably a similar stop loss. We probably had a stop loss again of about 15 pips. So again, we would do 150 divided by 15 pips. Okay, so 150 divided by 15 equals one lot. Okay, so that's £10 per pip. And this is obviously £3.30. £3.30 per pip. Okay, does that make sense? So we'd be risking £10 per pip on this one, £3.30 pip, £3.30 per pip on this one. All right, and then on the 2% risk. All right, so we would do, so on this one, our stop loss was just above these wicks here. So again, it was probably a similar position size. So again, we would do 200 divided by 15 pips. 200 divided by 15 equals 13.3. So that's 13.30 per pip. Yeah, because obviously 13.30 times 15 equals £200. So we can do 1.3 lots on that. So that would be 1.3 lots. And then on this position here, we were doing 2.5%. Okay, so therefore on this position here, we were getting in on this hourly candle. So our stops would have had to been above here. So we would have had to do a bit of a bigger stop in this one. Maybe we would have had to do something like 30. I would have probably said 30 pips on this particular trade. So therefore we do 250 divided by 30 equals £8.33. Okay, so this would be an £8.33. So we would just do basically the position size would be 0.85 or 83, which equals a £8.30 per pip. All right, so now let's work this out together, how much we would have made on all these positions at this point here. All right, so let's work this out. So our first position was £3.30 per pip. So £3.30, okay, would be, so we times that by 195. So times that by 195. So that's £643.50. So £643.50 on the first position. Okay. And then on the next position, we were doing £10 per pip. Okay, so we can go down to here and we would have made 150 pips. Okay, so 150 obviously times 10 would be 1500. So we would make 1500. 1500. And then on the next one, 2%, we were risking £13.30 per pip. So £13.30 times 93 pips would be 1,236. 1,236 and 90 pence. Okay, and then obviously on this position here, we're risking 2.5%. Now 2.5% is £8.30 because obviously we had to do a bigger stop on this one. So therefore we had to reduce our position size. Okay, so at this point here, from this point here down to here, would have been 75 pips. So 75 pips times £8.30 is £622.50. So this position here would have been £622.50. Okay, so all of our stop losses are now here. So therefore, if it drops and then it comes back up and takes us out, all of these positions that we've managed to scale in from the top, if it takes us up out here, then what we would have made is, let's add it all together, we would have made 643.50 plus 1,500 plus 1,236.90 plus 622.50, because that's £4,000. We would have made £4,000. Now on a £10,000 account, that's a 40% return. 40% return. Now basically what that is the secret of compounding, because basically what you're doing is when you're locking in the profit, okay, when you've locked in the profit initially from your first position, what you're doing is you're going half risk, and then you're using that half risk to add to your next percent that you get. So that's 1.5% risk because you've locked in the initial profit. You have to always make sure you're locking it in though, not just going break even. You have to lock in some form of the profit, and then in your next position you can go a little bit higher because you've got that guaranteed profit. And then once you've locked that in and you've guaranteed some profit on that, you can then put another half of risk on. And then once you've locked that in, you can put another half of risk on. You can keep doing this and keep compounding your account because you've got guaranteed profit. So when you've got that guaranteed profit and you're floating in the blue, you can use that blue to basically compound and add some additional risk to your position. Okay, now this is obviously going on the basis that you got stopped out here. Okay, that you moved all your stop losses down to here and you got stopped out. If you hadn't have got stopped out here, you can keep doing this. So let's say now we're completely out of the market, we made £4,000. So then the next entry would be here. Okay, the next entry would be here. So this is another scaling. So we start all over again. So if we get stopped out on all these positions here, we start all over again. But on this position, we go with 1%. Why would we go with 1%? Well, because we don't need to go with 0.5% on this particular position because we have now got loads of confidences. We've got some structure here. We've got the fib level look from here to here. We've got a fib level. We've got this counter trend line. We've got this descending trend line. We've broken and formed this head and shoulders pattern, which we're now retesting this neckline. Okay, so we're starting to build loads of confidences. So we don't need to bait the market now. We just go in with our normal risk. So if your normal risk is 2% or 1%, you just go in with the normal risk. But initially, when you're trying to pick these tops and bottoms, okay, and you're trying to jump into the market with no more than sort of, when you're trying to jump in with only 2 confidences, go in with half a risk. Okay, once you've got this half a risk locked into the market and you've baited up the market and you've fished out that first position, once you're in profit, lock some of that profit in and then use that profit that you've locked in to add an additional 0.5% to your next position, and do the same again and the same again and the same again. And you can scale in, and this is one of the techniques that I teach within the BS Up2FX course. Is basically how to get your first initial position within the market. Once you've got that position and you've got it, you've got it locked in, to then use the scale in technique to go down to the smaller time frames and start adding additional positions. And this is how you can make 40% on your account, but actually, locking in profits, scaling in, locking in profits, scaling in. But it's all about initially baiting the market, locking in that initial profit, and then using that profit from that trade. Because a lot of people, what they do is they do this, is where basically they get this first initial position, okay, and then they get this secondary position here, and then they close out this position, and then they let this position run, okay, and then they get this next position in here, they close out this position from here to here, and then they get this next position here, so they close out this one, and then once they've got this position here, they get this position, and then they close out this one. And that's just pointless, because really, what you could have been doing is you could have been sat all the way from this top one all the way down, okay, but because people are greedy and they want to just take the profit, they just close it. And you shouldn't do that. You shouldn't just close profit. If you're in the blue and you've locked in, say, a certain amount of pips on that, so, say, for example, you've locked in, I don't know, 20 pips, 30 pips, you can't lose now, guys. You cannot lose. So there's no reason as to why you want to close this trade. Don't close the trade. Let it run. Let it run. Let it run. Or you can watch the next video, or one of the videos I'm going to put on this psychology course, where I will teach you how to take partial profits. Where, if you do have a greedy mentality and you do feel like you want to get something out of the market, which is absolutely fine. I take partial profits myself. What you could have done is, on this position here, you could have taken off 0.25. On this position here, you could have taken off 0.75. This position here, you could have taken off 1%. This position, you could have taken off 1.25%. And you can actually take partial profits on the way down, but try and leave all of your positions within the market, because what you can do is you can leverage the profit that you've made on these first initial positions to actually help you add more risk to the next position, if that makes sense. I hope that mathematically makes sense to you guys. But this is a very strong way of compounding your account, very strong way of growing your account, is by using the scaling technique and basically using the profits that you're sat in from your initial position to actually reinvest almost and increase your risk for the secondary position. So I hope this helps. And obviously, if you do need more information with regards to the actual strategy that I do teach, the very deep and involved, tactics that I use, then you're more than welcome to obviously grab the BS Apps FX course as well, and actually become part of the community, because I appreciate there's going to be a lot of people that buy this course that aren't yet part of the course. But this is a very powerful way of compounding your account, by using the profit that you have open to actually add and compound, add, compound. And you can just keep doing this all the way down. And this is how a lot of the pros do it. So I hope this video has been helpful to you guys. Any comments or whatever, just give me a shout. Okay, guys, so following on from the video earlier, talking about baiting the market, I just want to show you a quick video on how to take partial profits. So what I'm going to do is just set up a quick account. It's just a demo account. It's going to take a few minutes. And then what we're going to do is we're just going to go through and just add some more symbols, basically. So we're going to add some, for example, euro to the pounds, some of the euro pairs, euro USD, some of the pound pairs, and just add all the majors as well, just to populate that list of currency pairs. So once we've gone through and done all this, just add our silver and gold and oil. Cool. So we've pretty much got our list now. Okay. So if we go to USD Swiss franc, what I'm going to do is just going to remove these lines quickly. And then what we're going to do is we're going to open up a trade on this particular pair. Okay, so we're going to put 5 lots as a buy. All right, we're going to put our stop loss at 0.9675. And we're going to enter the market at a buy of 5 lots. Now, obviously, we've not calculated risk and etc. But that doesn't matter. This is just to illustrate how to open a trade and obviously close a percentage of that trade. Now, obviously, this works really well with basically, when we're taking profit off at certain levels. It's something that is taught within the BS Apps FX course on how to take profit on the way down and when to take it at certain points that have been tried and tested. So as you can see, we've got 5 lots open here. So what we can do is, all we have to do, okay, we have to just click close, come to this screen here, and then we can just type in, say, 2.5 lots. So that would be obviously us closing half of our position right now. All right, so therefore we'd only take £2 loss at this point, £10, £12, it keeps moving obviously because price is moving. Or we can say, we can close out 1.5 lots, but we can't close out more than the position, so we can't close out 6, obviously. We can only close out the most of what we've got, which is 5. So this is 3 lots, this is what we would lose. So like I said, we've got 5 lots open, we've placed a buy. Now, obviously you don't really, there's 2 reasons as to why you want to take partial profits, okay? Number 1 reason is because you've over leveraged and maybe the position is going against you. You don't like the feel of it, so therefore you want to take maybe a little bit off because it's a bit too much for you. So maybe you went in with 5 lots at 2% risk, and actually you don't like the trade that much, so you want to take off 2.5 lots, and now only go in with 1% risk. So that's one of the reasons as why you can take partial profits to actually reduce your losing position. So if you're in a loss or in some form of drawdown, you can actually reduce your position instead of entirely closing it. So if you don't feel that confident about it, what you can do is half the risk to make yourself feel a little bit more confident about it and let it run. So sometimes you find that, most people close their positions too early because they don't have the confidence. So now we've just closed out 2.5 lots. Okay, so now we've just closed out our 2.5 lots. So what we can do now is we can just let it run. This is just showing an example of how we can obviously keep reducing our position size every time we fall into profit. So as I was saying, one of the main reasons is when people over leverage, they feel uncomfortable with the position, so they find themselves checking it every 5 minutes. Now, when you place a trade, you shouldn't be checking it at all every 5 minutes, because it just means that basically you're over leveraged. So this is a really nice way of being able to reduce your position size. Or alternatively, the second way you can obviously use taking partial profits is to obviously take off profit on the way down. So at least you're securing something. So now obviously you can see here we've typed in 1.25, which is 1.25 lots. So you can type in whatever you want. If we've currently got, I think, 2.5 lots open now on this trade. It's entirely up to you how much you want to take off at certain points. But this is simply just to illustrate how to take partial profit. Okay, so surprisingly enough, even people that you wouldn't expect, a lot of people do not know how to do this. So just wait for it to go into profit. There we go. So we just close off 1.25 lots in profit. Go to close again, and basically we can keep doing this. We can just keep reducing the position size. Obviously, you wouldn't do it this quickly because that would be silly. But you would, say for example, your take profit is 200 pips. Then maybe you would take off, maybe 1 lot at 50 pips, and then maybe another 1.5 lots at 100 pips, and you can basically take profit on the way down on your trade. So we've only got 0.75 open now. That's all we've got left. This actually looks like a really good trade to the upside. So we're only in £4.60 or £3.80 profit right now. £2, nothing major. So what we can do now is we can just go ahead and close that entirely. So that was just a demonstration there of showing you basically how to take profit early.